Have you ever watched a trend just completely flip on a dime and thought, man, I should have seen that coming? Well, today we are decoding a classic chart pattern that's basically a blueprint for those exact moments. Seriously, this has been a go-to tool for traders for almost 100 years, and we're about to see exactly why. Let's jump in.
So let's get right to it. Is it even possible? Can you really spot the moment a trend is about to run out of gas and turn around? You know, it's one of the biggest challenges in trading. But what if I told you there was a tool, like a geometric map, designed specifically to find these high probability turning points?
Well, say hello to the Gartley Pattern. And look, this isn't about gut feelings or just guessing. This is a foundational 5-point structure that uses the beautiful math of Fibonacci ratios to hunt down potential reversals. Think of it as a blueprint for finding a little bit of order in all that market chaos. And get this isn't some brand new, flashy idea. The pattern was first introduced way back in 1935 by a guy named H.M. Gartley. The fact that it's still a cornerstone of technical analysis today, well, that tells you everything you need to know about its staying power. Okay, so to really get the Gartley, we've got to look beyond just some lines on a chart. We need to see its shape and, maybe more importantly, understand the story it tells about what's going on in the heads of buyers and sellers. So let's break down that geometry first. The pattern basically comes in two flavors. They're just mirror images of each other. It's actually pretty easy to remember. The bullish Gartley, that's the one on the left. It kind of looks like a stretched out M. It pops up after a downtrend and basically screams that sellers are getting tired. Then on the right, you've got the bearish Gartley, which looks like a W, and it signals that buyers are running out of steam after a nice uptrend. Each shape is like a little visual map of a power struggle. And this right here, this is the absolute key. A Gartley pattern isn't just a random shape. It's the story of a failed trend. See, the market tries to keep going in its original direction, but it just can't quite do it. That failure, that hesitation, that's our critical clue that the whole momentum of the market might be shifting. All right, we've seen the shape, we get the psychology behind it. Now let's get into the nitty-gritty, the hard numbers, the blue point that makes the Gartley so darn precise. This is where we crack the secret code of Fibonacci. So every single valid Gartley pattern is built on these 5 key pivot points: X, A, B, C, and D. It all kicks off with a big move. That's your X to A leg. Then you get a pullback to point B, a smaller pushback in the trend's direction to C, and then finally, the all-important completion at point D. We call that the potential reversal zone, or PRZ for short. So what makes it a real Gartley? Well, this is where the Fibonacci recipe comes in, and it takes all the subjectivity out of it. For a perfect Gartley, the B point has to pull back exactly 61.8% of that first XA move. The other legs, they have a little wiggle room, as you can see. But the two most important non-negotiable rules are for that B point and the final D point. And the big one, the crucial one, is this number right here, 0.786. The entire pattern comes together when that final leg completes at the 78.6% retracement of the initial XA move. That's the defining signature of the Gartley. It's the hotspot, the zone where traders are on high alert, waiting for the turn.
Okay, so knowing what the pattern looks like is one thing, but actually trading it, that's a whole other ballgame. So let's turn all this theory into a super simple, actionable 3-step plan that you can use, getting us from spotting the pattern to actually making a trade. Here it is, your game plan. First up, entry. And this is critical. You don't just blindly jump in the second the price hits point D. No, you wait for a confirmation signal, like a big, powerful reversal candle. Step 2, your stop loss. This is easy, it has a logical home right beyond the X point. If the price goes past that, the pattern's busted anyway. And finally, step 3, your profit targets. These are also based on Fibonacci, usually the 38.2% and 61.8% pullbacks of the move from A to D. Simple.
But listen, here's something that separates new traders from experienced ones. Never, ever trade a pattern in isolation. A Gartley is really powerful, for sure, but its odds of working out go through the roof when other signals are pointing in the same direction. We call this idea confluence, and honestly, it's the key to high-conviction trading.
So what does confluence actually look like? Well, you could just ask 3 simple questions. First, is an indicator like the RSI showing an oversold or overbought reading? Second, is something like the MACD showing a crossover in your favor? And third, do you see a big spike in volume when the reversal happens? If you can get a yes to these, that's a powerful sign that the big money players might be on your side.
All right, time for a little reality check. No tool in trading is a magic bullet, and the Gartley is no exception. It's really important to understand its strengths, its weaknesses, and where it fits in with all the other similar patterns out there.
So on the one hand, the big advantages are its high probability and its super clear, objective rules. I mean, it takes a lot of the emotion and guesswork out of your plan, but the limitations are real. Gartley patterns can fail. They do give false signals sometimes, and that is exactly why you should never use one all by itself, and always look for that confirmation.
You know, it also helps to see how the Gartley stacks up against its cousins in the harmonic pattern family. As you can see here, patterns like the bat, the butterfly, and the crab, they look pretty similar, but they have different Fibonacci DNA. The butterfly and crab, for example, are what we call extension patterns, because their D points actually form past the starting X point. But the Gartley's unique fingerprint is that perfect combo, a 0618B point and a 0786 D point.
So if there's one thing I really want you to take away from all this, it's this. A Gartley pattern is not a crystal ball. It does not predict the future. What it gives you is a high probability setup with a clearly defined plan for managing your risk and your reward. It's a tool for being systematic, not for telling fortunes. At the end of the day, the Gartley gives you a powerful, time-tested blueprint for spotting potential market reversals. It gives you structure, objectivity, and a clear plan of attack. So the only question left is, now that you've seen the blueprint, what are you going to build with it?